Will the presidential candidate who won't increase federal deficits please stand up? Anyone?
Marketplace Morning Report is supported by Progressive Insurance. Customers can simplify their insurance needs and protect what's important by bundling home and auto. Learn more about bundling at progressive.com. And by Clear Channel Outdoor, an out-of-home billboard company that offers data-driven advertising solutions for businesses big and small. Billboardsforbusiness.com.
From Marketplace, I'm Nova Safoin for David Brancaccio. The Nonpartisan Committee for a Responsible Federal Budget released a new study this morning. It's looking at how the spending proposals of both Kamala Harris and Donald Trump would affect the national debt. And it looks pretty dire. Marketplace's Nancy Marshall-Genzer has the details. Good morning.
Good morning.
So, what are the numbers?
Well, the Committee for a Responsible Federal Budget says former President Donald Trump would increase the national debt more than twice as much as Vice President Kamala Harris. The report says the debt would go up by more than $7 trillion under Trump and by more than $3 trillion under Harris.
Pretty staggering numbers there. Both campaigns are making a lot of tax and spending promises. Do we know, have they said how they pay for them?
They have, but they're kind of vague, and the committee says it's not clear that their ideas on paying for their plans would actually work. Former President Trump has proposed big new tariffs on imports. He says he would close the education department and increase energy production in the U.S. Harris would raise the corporate tax rate and give Medicare more power to negotiate drug prices, and wealthy individuals would also pay more in taxes under her plan.
But there are caveats.
Absolutely, Nova. Some of what these candidates are proposing on things like taxes, well, that would have to go through Congress. And also the Committee for Responsible Federal Budget says at this point, it's just not enough for the candidates to only say they'll pay for the new spending they're proposing. The committee says they should tell us how they'll decrease the debt rather than just promising not to add to it.
All right, Nancy, thank you.
You're welcome.
And let's do the numbers. Dow, S&P, and NASDAQ futures are all down in the 0.3 to 0.4% range. The 10-year Treasury yield is up substantially at 4.018%.
Marketplace Morning Report is supported by Bitwarden. Wearing costumes to mask personal identities is a Halloween tradition. Bitwarden is a password management solution that can help disguise account information and identities from cyber creeps online all year long. Available at bitwarden.com. And by C3 Generative AI, verified traceable answers, secure hallucination-free, LLM-agnostic, IP liability-free C3.ai. This is Enterprise AI. And by Schwab. Schwab offers investors choices like full-service wealth management, self-directed investing options, and trading on Thinkorswim. More at schwab.com.
Private equity is an expanding corner of the investment world, now worth trillions of dollars as firms buy up everything from nursing homes to veterinary clinics. Jared Dillian, a financial analyst and commodities trader, has written critically of the industry and argues there's an unseen bubble in the private equity space. He spoke with my Marketplace colleague, David Brancaccio.
That space doesn't look good to you?
Well, private equity, no, it doesn't. You know, private equity made sense at one point in history. You know, if you go back about 10 or 15 years in the 2010s when interest rates were zero and valuations of private companies were like 4 or 5 times. And now interest rates are 5% and valuations are 10 or 12 times. It doesn't make a lot of sense. So what's happening is that these private equity firms are competing in deals to buy companies at higher and higher valuations with an enormous amount of leverage. And I believe it poses systemic risks.
All right, enormous amount of leverage because interest rates are higher. But just for the many people listening who don't fully understand this, private equity is open to wealthier investors, and they borrow, in the old days, lower interest rates. They buy companies, then what do?
Crucially, they're buying private companies, and they hold them for a period of time, usually 3 to 5 years, and they apply whatever management techniques to wring some efficiencies out of the business to increase the bottom line, and then they will sell the businesses to somebody else.
And you've been looking at the numbers here. One of the things that you've noticed you think is maybe a telltale sign is that private equity is holding the companies they've purchased, what, longer than before? What does that tell you?
It's difficult now for private equity firms to exit their investments. And what that means is that limited partners in private equity firms, the investors, are not getting cash distributions. So if you're a pension fund or you're an endowment and you have money in a private equity fund, usually this spits out cash over time. As companies get sold, they're not getting any cash.
And that's an important point to make, because it's not just well-heeled investors above our income range that care. It may be that you're into private equity because of your, for instance, pension fund.
Yeah, I mean, university endowments have actually been the biggest proponents of private equity. And there was an article in Bloomberg the other day that talked about the Harvard endowment. And the Harvard endowment is now 39% of their portfolio in private equity. And that's pretty similar across the board.
Now, we can't know where all this leads. No one can. But, Jared, if you're in a pessimistic mood with an imagination for disaster, are you worried that this downward pressure could lead to a bunch of private equity firms having trouble at once?
Here's the systemic risk. Here's the problem. So a stock market decline doesn't last very long. Like, even the financial crisis happened very quickly. But if you have 17,000 private equity firms liquidating their portfolios of companies over a period of 5 to 10 years, then it's going to result in depressed valuations for a very long time. So the next bear market that we have could take longer than previous ones we've had in the past.
Jared Dillian of Jared Dillian Money. He has a new report on private equity. We'll have a link on our website. Mr. Dillian, thanks so much for private equity. We'll have a link on our website. Mr. Dillian, thanks so much for this.
Hey, thank you.
A private equity bubble? How about the expanding bubble that is the holiday shopping season? It used to start after Thanksgiving. My phone got deal alerts over the weekend as retailers fret over disrupted shopping patterns. I'm Nova Safo with the Marketplace Morning Report. From APM, American Public Media.